If an exam question asks you to record a 10 lakh loan given to an employee at a 4% cash coupon while the market rate is 10%, recording it at face value is a mistake that will cost you the marks for the entire problem. To get this right, you have to master the specific mechanics of the amortized cost method under Ind AS 109. An asset must survive 2 hurdles to qualify for this method. It must pass the business model test and the SPPI test before it can be placed in the amortized cost bucket. This category covers the most frequent instruments in the syllabus. It includes security deposits, various employee loans, and bond investments. Because these instruments are so common, failing to apply these specific rules is one of the most frequent ways students lose marks on financial instrument questions. We begin with the standard scenario, market terms. This occurs when the loan's coupon rate perfectly matches the prevailing interest rate in the market. In this case, the relationship is simple. The cash paid out, the transaction price, is exactly equal to the asset's true fair value. You simply debit the loan asset for 10 lakh and credit bank for 10 lakh. When terms align with the market, your basic accounting intuition and the requirements of Ind AS 109 are the same. There is no need for complex mathematical adjustments. Complexity arises with off-market terms. When you deal with concessional or employee discounted loans, the equality between transaction price and fair value disappears. Ind AS 109 requires that initial recognition always happens at fair value, regardless of how much physical cash changed hands. Pause the video now and calculate the present value for this scenario: a 10 lakh loan, 5-year duration, and a 4% coupon, discounted at a 10% market rate. You have to look past the cash transaction. Calculating the present value is the only way to find the true economic value of the asset on day one. Combining the present value of interest and principal gives a true fair value of 7.72 lakh. You paid 10 lakh for an asset worth 7.7 lakh. That gap is your day one difference. You must route this difference based on the intent of the loan. Use prepaid employee expense for staff loans, right-of-use asset for lease deposits, or investment for loans to subsidiaries. This adjustment ensures the balance sheet reflects the actual business motive. It transforms what looks like a hidden loss into a transparent asset or expense. For subsequent measurement, you begin your amortization schedule using that initial fair value of 7,72,532 as the opening balance. Your P&L interest income must use the 10% effective interest rate, not the 4% cash coupon. The difference is added to the principal, steadily increasing the asset's carrying value each year. This process acts as a financial correction, pulling the discounted asset's value back up until it reaches the full 10 lakh face value by the time it matures in year 5. To summarize, market terms use the transaction price. Off-market terms require the present value, a day one adjustment, and the effective interest rate. The fatal mistake is recording interest based on the physical coupon rate instead of the effective interest rate. Keep this rule in mind. Market terms mean face value. Off-market terms mean fair value first. The entire accounting sequence relies on identifying whether the terms align with the market. Once you verify that initial detail, the rest of the calculation follows a logical, predictable path.